Now let's bring in CNBC contributor, Trivariate's Adam Parker. It's good to have you here.
Thanks for having me.
How are you thinking about this? Because the market doesn't like it, obviously.
Yeah.
Market doesn't like the constant, beat down that the president's been giving the Fed chair. That suggestion that he was going to fire him unsettled the market for about 5 minutes. But what do you think?
I mean, the president's shown many, many times that after he talks to somebody, that person can influence their opinion. So part of me has thought that Powell should just talk to him and tell him what his view is of rates and why he's, on the path he's on, and that might actually move the president's prior view a little bit. I think there's a lot of examples and a lot of different subparts of being president. He's shown the ability to be influenced by people who sit down and talk to him.
So, do you think Powell should cut rates?
I personally do not. But as you know, I'm not like a rate guy. That's not what I do. But I think if he does, the market might not necessarily act great. I think what everyone hopes is that it helps industrials and housing and other things that have been in a recession. I think it'll cause a rotation within the stock market, and you'll get home builders and retailers, ripping and that kind of stuff.
Well,
but
isn't that a good thing? Like, why wouldn't the market react positively to a rate cut?
Well, the same way it didn't always react negatively to the rate hike. As you get toward the end of the rate hike cycle, last time it was January of 23. You covered your NVIDIA Meta shorts, which were down 60, 70% in 2022, and they got massively outperformed, even though they were still hiking. So at some point, you're going to be closer to the end of the accommodation than the beginning, and the market's not going to say, yay. It's going to say, well, wait a minute, maybe things are slowing a little bit, or, so maybe you'll get a knee-jerk reaction that one day, but underneath it, do you really think there's things that are going to get stimulated by cutting the front end? I mean, the banks are in amazing condition with great balance sheets.
Yeah, so they get more.
We'll see. Yeah, I'm overweight the financials, and I think it's probably the most crowded long idea I have, but I think the risk reward's good. I just don't know if you take what they're really supposed to be doing, which is full employment and stable pricing, and ask yourself with the data, does it really show they need to? I'm not sure.
Well, but they believe, Powell does, that they're still too restrictive. I mean, he said as much. So both of those things that you just said, they're too restrictive from where they were.
I guess the unemployment rate's pretty low. And
why don't protect this house, right? Protect the house.
So the question is, how anticipatory are they going to be this cycle? Look, the two things that matter for equity investing in the medium to long term are changes to perception about growth and changes to perception about rates. If I mark to market where we are, the changes to perception about growth are higher than they were a few months ago.
Mm-hmm.
I
bullish,
mean, right? That's bullish. And the change in perception about rates, if they're more dovish or I think it's bullish. So the cocktail, I think, is risk reward positive for equities, and I'm not surprised they act well. Sure, we want, and I agree with Leisman, we want independence. We want that. We don't want to pierce that.
You think it matters as much as we want to believe that it does?
I think it does. Look, in the long term, I don't think the president matters. There's all those things the president takes credit, but probably and blame. It probably doesn't really deserve either. Economics and interest rates and policy cycles can go, before and after the president's influence. This president happens to be more of a markets person than some of the previous ones and focuses on it a lot and probably has experience in interest rates given the real estate background and the multiple bankruptcies and all that kind of stuff. So he has his own view. When I look at it, I think, I don't know if they really need to cut rates a ton. And if they do, there'll be a short-term rotation in the market followed by back to thinking about the perception of growth. I think the challenge where we are right now is there's a chance we get a growth scare August to October this year just based on a different thought about the growth rate. But I think the other side of this, 26 and 27, we still have this dream that's kind of hard to break about productivity from AI. And so none of this, I think, matters in a 6-month view.